Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. For the week ending September 2nd, the markets had a lousy week for the most part. In healthcare, biomedical, healthcare, and drugs all declined. In media communications, internet and media declined. On the bear side, telephones declined. In technology, electronics, software, and computers all declined. On semiconductors declined and crossed to the bear side. In consumer discretionary, gaming, restaurants, leisure, retail, autos, and household products declined. In the financials, savings and loans were unchanged. Wall Street, banks, finance, and real estate declined. On the bear side, insurance declined. In the industrials, waste management, aero defense, machinery tools, chemicals, and building products all declined. On the bear side, steel and metals declined. In the others group, on the bull side, electric utilities, transports, textiles, and business products declined. Protection and safety was unchanged. On the bear side, oil, oil services, and gas utilities declined. Food and forest products declined, and precious metals were unchanged. For the week ending September 2nd, three sectors were unchanged, none advanced, 37 sectors declined, one sector, semiconductors, crossed to the bear side. There's now 29 on the bull side and 11 on the bear side. Overall, the market score declined 41 to 25. The week ending on September 2nd, 2022, the S&P 500 closed at 3924, down 133.4 and off 3.29%. The Dow Jones Industrials closed at 31,318, down 964 5 points, or 3%. NASDAQ closed at 11,632, down 510.85% points, and 4.21%. This week, 482 stocks went from a buy signal to a sell signal. There were 4 new listings. There's now 34% of stocks on buy signals and 66% on sell signals. Overall, our market score changed from 41 to 25. In summary, tech and basic materials were down the most this week, led by semis getting crushed for the second consecutive week. The only reason the sectors have not crossed to the bear side is that to do so, they have to go below the low mark of the previous decline. That's a very low bar because we hit 3620 on the S&P 500 in June, and we're not there yet. This may become the first time in 20 years I've seen the sectors collect at the 6 o'clock position from the bull side. Most unusual, but I see it is about to happen. For the first 35 weeks of 2022, the S&P 500 is down 17.68%, a little over 18% from its high. NASDAQ is down 24.67%. Energy is still the leading sector, up 44% year to date. For the first 35 weeks of 2022, healthcare is down 9.99%. Media communications is the worst, down 30.68%. Technology is down 22.6%. Consumer discretionary stocks are down 23.94%. Finance stocks are down 15.11%. Industrials are down 12.8%. Real estate stocks are down just over 20% at 20.32%. And basic materials are down 17.95% year to date. For the past week, the S&P 500 was down 3.3%. Nasdaq was down 4.2%. The energy sector stumbled and was down 4.6%. Healthcare was the best performing set of stocks, down 1.8%. Media communications were down 2.4%. Tech was the worst, down 5%. Consumer discretionary stocks were down 2.6%. Financial stocks were down 2.4%. The industrials were off 3.4%, same as last week. Real estate was down 3.9%, and basic materials were down 1.3%. 4.8%, the second worst performing sector. For the week ending September 2nd, the 10-year Treasury bond yields ended at 3.193%, up 18 basis points this past week. Interest rates seem to be on a steadily climbing slope. For the week ending September 2nd, West Texas Intermediate crude oil closed at $87.25, down $5.81 this past week, or 6.2%. Wholesale gasoline, RBOB, closed at $2.46, down 39.15 cents last week, or 13.7%. Well, that's odd. I sure didn't see that at the pump last evening. Pump prices were down less than 25 cents. Subscriptions are available for $12 a month on an annual contract or $15 a month on a month-to-month contract. I've been producing the Slay the Spider Circle since 1998 and using it to manage private client assets. I've been nearly completely out of stocks for the past year. My portfolio performance is now well ahead of the S&P 500 and Nasdaq indices since I went into cash. That's the total idea behind Slay the Spider. Outperform the indexes in both up and down markets. Now is an excellent example of cash beating the market substantially. I'm looking forward to buying many of the stocks I owned previously at prices well below what I sold them for last year. I will then own more shares going forward, in some cases twice as many. Sure, there were a few stocks I wish I had kept, but in total, I'm more than happy avoiding this bear market.